In today's video, we will go over one of the more basic portfolio construction methodologies, inverse volatility weighting. Even though it is more basic by nature, it is still widely used in the industry. By the end of this video, you will know the whole theory behind it, all the way from math to implementation in code. We will go over a real-life multi-asset example that you can see on screen right now. We will backtest our multi-asset portfolio using the inverse volatility weighting strategy. It is not just important what securities you will pick into your portfolio. As we will see, it is also very important on how to weight them in the end. So let's jump right into it. At Code & Capital, we focus on three simple pillars: rigorous research, practical implementation, and institutional quality portfolio construction and backtesting code. And this is exactly what we will do in this video about inverse volatility weighting. Most people spend almost all their times on signal creation, on what securities to pick, but definitely not enough time on how to weight them after they pick their securities. But in reality, the weighting scheme is very important and by itself can completely change the portfolio. We can have the same signal with different weights yielding to complete different results. Today we will go over one of the easiest or most simple portfolio construction strategies that you can build. But it's definitely one of the more powerful ones as well: inverse volatility weighting. It is very easy to understand, it is easy to implement, and far more important than most people actually realize. It's not just a toy idea either. Like, people in industry actually use it on a daily basis. For example, MSCI uses in their low volatility, risk averse strategies. Robeco recently published a paper on it and mentioned that it is a more risk averse, improved version of equal weighting your portfolio. Inverse volatility weighting is really about one thing: translating risk into capital allocation. Volatility is simply a measure of how much one asset moves by itself. Higher volatility means larger and more unpredictable price swings, whereas lower volatility means more stable assets receive more capital. You can think about bonds, for example, being less volatile, so they would probably receive a higher weight than an equity position in your portfolio. Inverse volatility takes this information and translates it into portfolio weights. Assets that are more volatile receive less capital, while more stable assets receive more capital in the end. The core idea is pretty straightforward. You don't want to allocate the same amount of money to a stock that moves 15% a year versus a stock that moves 50% a year. The risk simply influences how much capital you allocate per position. Formally, weights are proportional to the inverse of volatility, meaning, as you can see on screen right now, we take 1 divided by sigma, where sigma is the volatility measure of that security here. And then we just normalize that across the whole sum of all the volatilities of the assets in the portfolio. In practice, we will often see a more or even stricter variant of it. Instead of using sigma, you use sigma squared, the variance of each position, not the volatility by itself. Many institutional implementations, like the MSCI indices, for example, use the inverse variance, not the inverse volatility. Even though most people loosely refer to the concept as inverse volatility weighting either way. So to conclude our little definition here, let's compare the three most common weighting strategies. Equal weighting ignores risk altogether or entirely, whereas market weighted weighting, like indices like the S&P 500 or the Russell 1000, they just care about the market cap of the position. So Apple, being a large cap stock, will have a way higher market position than an equal weighting, for example. Inverse volatility, on the other side, they explicitly account for the risk or on how risky each asset is by itself. A useful way to think about it is basically equal weight is $1 per asset, whereas inverse volatility is approximately 1 unit of standalone risk per asset. Let's jump straight into our coding example. As mentioned in the introduction, we will build a multi-asset portfolio using our inverse volatility weighting strategy. We will use equity indices like the S&P 500 and the Nasdaq 100, as well as bond indices like IG high yield or treasury bonds, and we use commodity futures for oil and gold, as well as more recent cryptocurrencies like Bitcoin. And when we load this, we can look at the pricing history over time. We will see that our S&P 500 obviously has the highest returns over the last 10 years, outperforming real estate and IG bonds by quite a margin. We can now jump into the coding exercise of this video. We want to implement the inverse volatility weighting strategy that we just saw in theory. If we want to go back here, we can really see all we have to do is create our volatility in the first place and then divide it by the sum of all volatilities of the portfolio. So we can look at that now. We can simply start by defining our volatility, and before we do that, we start on a return data frame for all our assets over the last 3 years. So all we really have to do is, in the beginning, we take our returns and we take the standard deviation of those returns. If we look at that, we can already see for each asset we now have the standard deviation of that asset. We can now implement our inverse volatility, and that is simply 1 divided by vol. So if you look at inverse volatility, we can now see the inverse volatility per asset. And now if we go back here, we already have the top part of our equation, the 1 divided by volatility for each asset. All we have to do now is create our weights by following this equation, doing our volatility divided by the sum of inverse volatilities. So we can already set our weights to inverse volatility divided by inverse volatility, the sum of all our assets. And if we run that, we can see, if we look at our weights, we can now see the weights per asset in data frame form. And our intuition that we had earlier was correct. We can see that bonds have a higher weight of like 13 to 17%. The dollar by itself has a high weight, which is a relatively stable asset, compared to all our equity indices that mainly lie between 4 to 6%. We can also see that oil, relatively volatile, especially recently with political reasons, has a 2.5% weight compared to those 17% that you see in bonds. So you see, in 3 lines of code, we easily computed the weights for our multi-asset strategy for 1 period. Before we jump into our full backtest on using inverse volatility weighting on our multi-asset strategy over time, I want to just quickly mention why investors use it and why you should know about the inverse volatility weighting strategy. First of all, inverse volatility weighting is often the first step into risk-based portfolio constructions. It is simple enough to implement. As we just saw, you can implement it in 3 lines of code, but it's powerful enough to materially change your portfolio behavior. You basically walk away from just easily weighting your portfolio to having the risk in mind. It explicitly adjusts capital based on how volatile each asset is, and rather than just treating all assets the same. One of its key advantages is that it avoids one of the hardest problems in finance, forecasting returns. Instead, it relies solely on volatility, which is easy enough and in general more stable to estimate. In practice, this often leads to portfolios with lower realized volatility and more stable behavior compared to naive equal weighting or cap weighting portfolios. It also naturally connects easily to the low volatility effect, where it is proven that lower risk assets have historically delivered strong risk adjusted returns, meaning the weighting scheme can implicitly capture part of that phenomenon. You just need to be able to lever up your weight. More broadly, it sits on the practical sweet spot of being more informative than a naive diversification, just as equal weighting, but less fragile than a fully optimized portfolio, just as those model heavy approaches. So, why do investors not use it that much then? What are the key limitations of that strategy? First of all, inverse volatility weighting can feel diversified because it scales by risk, but it does not consider correlations between assets. It can still hide concentrated bets that way. Portfolio risk is not determined by individual volatility alone. It also depends on how assets move relative to each other. And that is by definition captured by the covariance or correlation matrix. Inverse volatility, as I mentioned, only considers standalone volatility and ignores those correlations, which means it does not account for how risks can cluster across assets. This leads to one important consequence. Even if individual positions look balanced in terms of volatility, the portfolio can still be highly concentrated in correlated exposures. For example, if we have a lot of different bond indices and only one equity indice, we could be all of a sudden 95% in a bond portfolio, which we probably don't want to be, or which we wouldn't call a diversified portfolio in the end. In reality, equalizing standalone volatility is not the same as equalizing actual risk contributions. Those depend on the full covariance matrix, and we will introduce strategies to use the covariance in future videos. As the next step, let's look at our inverse volatility strategy over time in a full backtest. To run our inverse volatility weighting strategy on our multi-asset universe over time, we will test it in our Code and Capital backtesting framework. As you can see, I already implemented or imported everything we need, for example, our strategy, as well as our inverse volatility weighting package. Even though we don't need the whole covariance matrix, we only need the diagonal. We calculate the covariance matrix using the Ledoit-Wolff covariance measure, which we will go over in a future video. In a shortcut, it just basically uses a shrinkage in the background to make to account for some outliers and basically makes the ride a little bit more smooth than just taking a default covariance matrix from simple returns. I implemented 4 different time frames. Once we only look back for 3 months, for 6 months, for 12 months, and then for 2 years. All we have to do then is create our strategy objects. We implement the equal weight strategy as one of our benchmarks in this test, and then you can easily see that our 3 months, 6 months, 12 months, and 24-month strategies are created in a couple of lines of code. All we have to do, we run our strategy daily. We select all of our indices in our multi-asset portfolio. We then calculate the covariance of whatever lookback we are looking at. we weight them by inverse volatility, and we rebalance our portfolio. As you can see, I ran that backtest, and our 5 different strategies, including equal weight, ran in under 10 seconds. If we now look at it, we can see that equal weighting our portfolios outperforms all of our different time frame lookbacks for inverse volatility, which makes sense. In the first place, it makes sense because we are underweighting risky assets. That is one of the drawdowns of inverse volatility. Could be that in higher returning markets, as we had in the last couple of years, we had a strong bull market, and the upside is not captured that well, as we, by definition, we are more invested into bond funds versus equity funds. If we look at the weight over time, that basically shows us what are we invested in. And we can see that our US dollar weight fluctuates between 10 and 12%. We have our COVID shock here, which is a little surprisingly that in the COVID shock, it liked Bitcoin a little more than it historically liked Bitcoin. But in general, you can see that it likes the bond funds. You can see the treasury bonds being around 10 to 15% all the time, as well as IG bonds and high yield bonds. If we look at the current portfolio, you can see we are currently 12% in high yield bonds, we are also 12% in treasury bonds and 11% in IG bonds, as well as 11% in the US dollar. So what is the upside of using inverse volatility? You can see even though the total return is lower in all of our strategies, the main advantage of the inverse volatility is the third row here. It has across all different look-back timeframes, it has a reduced volatility or annualized volatility compared to the equal weight strategy. You can see that the equal weight strategy has around a 14% annualized volatility, whereas our inverse volatilities rank around 9%. Another big advantage is it protects you against drawdowns. The max drawdown in our equal weight strategy during the COVID period was 37%, whereas the inverse volatility strategy using a 2-year look back has less than half of that. It only the max drawdown here was around 17 to 18% only. A similar measure, you can look at the value at risk, where our equal weighting value at risk is about 1%, whereas for the inverse volatility, it is only around 7 basis points. Also, looking at the Sharpe ratio, we can see that the Sharpe ratio for an equal weight portfolio was around 0.79. It's similar to using the inverse volatility 3 or 6 months measures, which also rank around those 0.8. But if you look at the Sharpe ratios for the 12 months and the 24-month look back, you can see a clear improvement. And that's just by the definition of having a very low volatility. So in general, structurally inverse volatility introduces consistent tilts to lower beta, lower volatility exposures, and it biases defensive sectors and defensive asset classes, just as bonds or the treasury bonds, the IG bonds, or the US dollar by itself. You reduce your downside risk, but you also have a lower upside captured, as we saw in our backtests. In general, yeah, it often improves your drawdown behavior as the portfolio naturally tilts away from those higher risk assets. The key takeaway here is simple now. Portfolio construction is part of the strategy. It's not just an afterthought. Inverse volatility is a great example of exactly that. It's simple but not simplistic, and it can materially change both the risk and behavior of your portfolio. It often improves risk-adjusted outcomes and reduces volatility, as we have seen in our multi-asset example, but it is definitely not free lunch. Performance depends heavily on the universe, the market regime, and how you can actually implement it. And that's the real point here. Weighting is not just cosmetic, weighting is the actual strategy. Inverse volatility also just a natural starting point. It is clean, it is a robust baseline before moving to a more advanced method like equal risk contributions, minimum variance, or maximum diversification. All strategies that we will explore in future videos. At Code & Capital, this is exactly what we focus on. We building these methods and methodologies properly, we implement them in a flexible and research-grade framework, and understand how each design choice impacts real-life results. Because in quantitative investing, the edge is not just what you buy, it's how you size it. And that's the difference between a toy backtest and a serious backtested research.